Before we begin today's analysis, a brief word. If you value thoughtful, disciplined financial perspectives that cut through market noise, I invite you to subscribe to this channel. You'll find the subscribe button below in red. We don't chase headlines here. We study patterns, assess risks, and prepare for what the markets may bring. If that approach resonates with you, please join us. Now, let's examine what's happening with gold. Something unusual is occurring in global financial markets. Gold is not behaving like a commodity. It's behaving like a monetary safe haven in a world losing confidence in traditional anchors. The question before us today is not whether gold will reach $15,000 per ounce. The question is whether the structural forces driving this asset class have fundamentally changed the risk calculus for every investor, regardless of their current portfolio allocation. This matters because we are witnessing signals that appear once in a generation. Central banks are accumulating gold at rates not seen in decades. Sovereign debt levels have reached mathematical endpoints. Currency volatility is accelerating. And institutional investors who dismissed gold for years are quietly repositioning. If you hold gold, you need to understand what comes next. If you don't, you need to understand what you may be missing. This is not about speculation. This is about structural preparedness in an environment where traditional diversification may no longer provide the protection it once did. Over the next 25 minutes, we will examine the specific forces driving gold, the historical patterns that validate this moment, and the disciplined strategies that separate informed investors from reactive ones. Gold has entered a new phase. But to understand where we're going, we must first understand what has changed. For decades, gold traded primarily on two factors: inflation expectations and real interest rates. When inflation rose, or real rates fell, gold typically performed well. And when the opposite occurred, gold struggled. That framework still holds partial validity. But something more profound is happening beneath the surface. We are witnessing a reconfiguration of the global monetary system, not a collapse, not a reset, but a slow, deliberate shift in how nations and institutions view the role of gold in their reserve structures. This shift is being driven by 5 structural forces. According to World Gold Council data, central banks purchased over 1,000 metric tons of gold annually for multiple consecutive years. This is not opportunistic buying. This is strategic repositioning. Why does this matter? Because central banks operate on different time horizons than retail investors. They think in decades, not quarters. When they accumulate at this pace, they are signaling a fundamental reassessment of systemic risk. Total global debt now exceeds $300 trillion. Sovereign debt to GDP ratios in developed economies have climbed to levels historically associated with post-war periods or financial crises. This creates a policy trap. Governments cannot afford significantly higher interest rates without triggering debt spirals, yet they also cannot perpetually suppress rates without eroding currency confidence. Gold thrives in this environment. Not because of inflation alone, but because of the loss of faith in the sustainability of current monetary arrangements. The post-Cold War era of dollar hegemony and integrated global trade is fracturing. Sanctions, trade wars, and the weaponization of financial infrastructure have prompted nations to seek alternatives. Gold is stateless. It has no counterparty risk. It cannot be frozen, sanctioned, or devalued by decree. For nations seeking monetary sovereignty, it remains the ultimate neutral reserve asset. For years, gold was dismissed by mainstream finance as a barbarous relic. That narrative is shifting. Pension funds, sovereign wealth funds, and family offices are allocating to gold not as a speculation, but as portfolio insurance. When institutions move, they move size. And when they move size into an asset with limited supply elasticity, prices adjust accordingly. Gold mine production has plateaued. Discovery rates for new major deposits have declined. The easy gold has been found. Extraction costs are rising. Unlike fiat currency, you cannot print more gold. This fundamental scarcity becomes increasingly relevant in a world where monetary expansion remains the default policy response to every crisis. These 5 forces are not temporary. They are structural, and they are all pointing in the same direction. History does not repeat, but it often rhymes. And the patterns we see today echo moments of profound monetary transition. Consider the 1970s. Gold entered that decade at $35 per ounce, held there by the Bretton Woods system. When that system collapsed and currencies floated freely, gold climbed to over $800 by 1980. That was not a bubble. That was a repricing of gold against the diminished purchasing power of fiat currencies and the uncertainty of a new monetary regime. The parallels to today are striking, though not identical. In the 1970s, we had visible consumer price inflation. Today, we have asset price inflation and currency debasement occurring primarily on balance sheets rather than in grocery stores. In the 1970s, debt levels were manageable. Today, they're existential. In the 1970s, gold was primarily a Western phenomenon. Today, it is global, with China, India, and emerging markets representing massive sources of demand. Gold tends to move in multi-year bull markets punctuated by sharp corrections. The 1970s bull market lasted approximately 9 years. The 2000s bull market lasted approximately 11 years. During these cycles, gold did not move in a straight line. It experienced drawdowns of 20% to 30% that shook out weak hands, but the structural trend remained intact. Importantly, gold's most explosive moves occurred in the final stages of these cycles, when awareness shifted from early adopters to mainstream consciousness. We saw this in 1979-1980, when gold more than doubled in less than 2 years. We saw this again in 2010-2011, when gold surged from $1,100 to $900. Gold broke above its 2011 all-time high in 2020. Since then, it has consolidated, built a base, and recently broken to new nominal highs again. If historical patterns hold, we are potentially in the middle innings of this bull market, not the end. The explosive acceleration phase, if it comes, would likely occur in response to a catalyst that shifts mainstream perception. That catalyst could be a currency crisis, a sovereign debt restructuring, a major geopolitical event, or simply the cumulative weight of the structural forces we've discussed. The point is not to predict the catalyst. The point is to recognize that the structural setup resembles moments that preceded major repricing events. Markets are not machines. They are composed of human beings making decisions under uncertainty. Understanding the psychology driving gold today is as important as understanding the fundamentals. Because gold runs counter to modern financial narratives, we are taught that stocks always go up over time, that technology drives wealth creation, and that gold is an outdated anachronism. These narratives work brilliantly during periods of monetary stability and confidence, but they fail during periods of transition. The investors who profit most from gold cycles are not those who are most bullish. They are those who recognize regime change early and position accordingly. This requires intellectual flexibility. It requires the ability to hold two ideas simultaneously, that the system has functioned one way for decades, and that it may function differently going forward. Most investors cannot do this. They anchor to recent experience. They assume stability is permanent. They dismiss warning signs until it's too late. Disciplined investors understand that gold is insurance, not speculation. They allocate systematically. They tolerate volatility. They do not chase price. Reactive investors buy gold at tops, when fear peaks and headlines scream. They sell at bottoms, when confidence returns and gold becomes unfashionable again. The pattern repeats every cycle. And every cycle, those who lacked conviction pay tuition. In the early phase, gold rises quietly. Only contrarians and institutional buyers participate. The mainstream ignores or mocks it. In the middle phase, gold's rise becomes undeniable. Financial media begins covering it. Skepticism remains, but curiosity grows. In the late phase, gold becomes a mania. Taxi drivers discuss it. Retail investors pile in. Prices disconnect from fundamentals. This is where fortunes are made and lost. The critical skill is recognizing which phase you are in. Overconfidence in the early phase leads to undersized positions. Overconfidence in the late phase leads to catastrophic losses. Based on current positioning, institutional flows, and public awareness, we appear to be transitioning from early to middle phase. Gold is gaining attention, but it has not yet reached mainstream consciousness. If this assessment is correct, the most explosive gains and the most dangerous psychology likely lie ahead. Real interest rates, nominal rates minus inflation, are the single most important driver of gold over time. When real rates are deeply negative, holding gold has no opportunity cost. You're not sacrificing yield to own it. In fact, you may be protecting purchasing power more effectively than bonds. Despite recent central bank rate hikes, real rates in many economies remain negative or barely positive when measured against true inflation rather than official statistics. This environment is friendly to gold. It may persist for years if central banks face political pressure to keep rates low despite inflation risks. We are entering an era where fiscal policy, not monetary policy, drives economic outcomes. Governments are running large structural deficits. They are funding these deficits through bond issuance and central bank accommodation. This is fiscal dominance, the subordination of monetary stability to fiscal imperatives. Historically, fiscal dominance periods are inflationary over time. They erode currency purchasing power, they benefit hard assets, and punish savers holding cash. Gold is the ultimate hard asset. It has no duration risk, no credit risk, and no reliance on government promises. For decades, the US dollar has served as the world's primary reserve currency. This granted enormous privileges to the United States, including the ability to run persistent current account deficits and accumulate debt. That system is slowly eroding, not collapsing, but eroding. Trade settlements in currencies other than the dollar are increasing. Bilateral currency swap arrangements are expanding. Central banks are diversifying away from dollar-heavy reserve portfolios. Gold benefits from this trend. As confidence in any single currency wanes, gold becomes the neutral alternative. Some analysts argue we face deflationary debt collapse. Others argue we face inflationary currency debasement. Here's the reality. Gold can perform in both scenarios. In deflation, gold performs well because it has no counterparty risk. When financial assets fail and trust evaporates, gold becomes a safe haven. In inflation, gold performs well because it maintains purchasing power against depreciating currencies. The only scenario where gold struggles is stagflation with rising real rates, an environment where central banks aggressively tighten despite weak growth. This scenario is politically and economically difficult to sustain. It requires a central bank willing to accept recession to defend currency credibility. In today's highly leveraged world, that willingness is questionable. Therefore, gold's risk-reward profile appears asymmetric. The scenarios that hurt gold are politically difficult. The scenarios that help gold are structurally probable. If you already own gold, either through physical metal, ETFs, or mining equities, you face a different set of decisions than new investors. Let's address your specific considerations. Gold is volatile. It can rise 20% in weeks, then give back half those gains in days. If you attempt to trade these swings, you will likely underperform a simple buy and hold strategy. The majority of gold's gains occur during brief, explosive periods. If you are out of position during those periods, you miss the entire point of owning gold. Set a strategic allocation, hold it through volatility, rebalance periodically, but do not day trade gold unless you are a professional with systems and discipline. Gold is insurance. Insurance is most valuable during crises, but crises are also when rational decision-making becomes difficult. Define in advance the conditions under which you would reduce or exit your gold position. Is it a specific price target, a change in real interest rates, a resolution of fiscal imbalances? Having a predefined framework prevents emotional decisions during volatility. Physical gold provides true ownership and crisis protection, but it incurs storage costs and liquidity constraints. Gold ETFs provide liquidity and convenience, but they introduce counterparty risk and do not offer the same crisis protection as physical metal. Mining equities provide leverage to gold prices, but they introduce company-specific risks, operational challenges, and equity market correlation. There is no single correct answer. The optimal approach depends on your specific goals, risk tolerance, and crisis scenarios you are preparing for. Many sophisticated investors hold a combination: physical gold as deep insurance, ETFs for liquidity, and selective mining equities for upside leverage. A common mistake among gold holders is overconcentration. They become so convinced of gold's prospects that they allocate 50%, 70%, or even 100% of their portfolio to it. This is dangerous. Gold can experience multi-year bear markets. It can underperform other assets for extended periods. And psychologically, it becomes nearly impossible to hold an overconcentrated position through volatility. Traditional portfolio theory suggests 5% to 15% allocations to gold. More aggressive investors might justify 20% to 25%. Beyond that, you are no longer diversifying. You are speculating. And speculation requires perfect timing, which no one possesses consistently. Gold commentary is filled with extreme predictions, conspiracy theories, and ideological agendas. This noise is unhelpful. Focus instead on the structural forces: central bank behavior, fiscal trends, currency dynamics, supply constraints. When these structural forces remain intact, maintain your position. When they shift meaningfully, reassess. But do not adjust your strategy based on short-term price movements or sensational headlines. If you do not currently own gold or own only a minimal amount, your considerations differ. Not every investor needs gold. If you are young, have high risk tolerance, and are building wealth through equity investments, a zero allocation to gold may be rational. But if you are approaching retirement, have accumulated significant wealth, or are concerned about systemic risks, gold deserves consideration as portfolio insurance. The role of gold is not to maximize returns. The role is to provide asymmetric downside protection during periods when traditional assets fail simultaneously. Start modestly. A 5% allocation is sufficient to provide meaningful portfolio protection without introducing excessive concentration risk. If you have strong conviction, you might build toward 10% to 15% over time. But do not rush. Gold has had sustained bull markets lasting years. You do not need to capture every dollar of upside immediately. This is where most investors paralyze themselves. They wait for a pullback. The pullback never comes, or when it does, they convince themselves it will fall further. The solution is systematic accumulation, dollar cost average over 6 to 12 months. This removes emotion, averages out volatility, and ensures you establish a position. If gold corrects sharply during your accumulation phase, accelerate your purchases. If it rises, you have captured some upside while maintaining discipline. In many jurisdictions, physical gold is taxed as a collectible, with higher capital gains rates than equities. Gold ETFs may have different tax treatment. Consult with a tax professional before making large allocations. Tax efficiency matters over long time horizons. Gold should not exist in isolation. It should complement your equities, bonds, real estate, and other assets. The question is not whether gold will outperform everything else. The question is whether it improves your portfolio's risk-adjusted returns and provides insurance during tail events. Modern portfolio theory demonstrates that adding uncorrelated assets, even lower returning ones, can improve overall portfolio efficiency. Gold's low correlation to stocks and bonds makes it valuable in this framework. If you buy gold and it falls 15%, you will regret buying. If you don't buy gold and it rises 50%, you will regret not buying. Regret is unavoidable. Accept it. The goal is not to avoid regret. The goal is to build a resilient portfolio that survives multiple scenarios. Gold is part of that resilience, not a magic solution, not a guaranteed winner, but a rational allocation in an uncertain world. Even disciplined investors make mistakes. Let's identify the most common errors so you can avoid them. Gold can rise 10% in a week. When this happens, media coverage intensifies. Investors who ignored gold suddenly feel compelled to buy. This is precisely the wrong time to establish a large position. You're buying on emotion near local tops with maximum risk and minimum reward. If you missed a move, wait for consolidation or pullback, or build a position slowly regardless of price, but never chase parabolic moves. Gold's volatility attracts speculators seeking outsized returns through leverage. This rarely ends well. Gold can remain range-bound for months, slowly eroding leverage positions through time decay and margin requirements. If you must use leverage, do so with extreme position sizing discipline and clearly defined risk limits. For most investors, unleveraged exposure is appropriate. Some dealers sell collectible coins at premiums far above bullion value, claiming they will appreciate more than standard gold. This is almost always a poor investment. You're paying huge markups for uncertain collectible value. If you want gold exposure, buy bullion or ETFs at tight spreads. Physical gold is valuable and portable. This makes it a target for theft. If you own physical gold, invest in proper storage. A home safe, a bank deposit box, a professional vault service. Do not cut corners, and never discuss your physical gold holdings publicly. Security through obscurity is your first line of defense. Gold mining stocks can provide leverage to gold prices, but they are equities, not gold. They face operational risks, political risks, management risks, and equity market correlation. During severe market stress, they may fall alongside stocks, even if gold rises. Understand what you own. If you want pure gold exposure, own gold. If you want equity leverage to gold, own miners, but recognize the additional risks. Some investors start with a sensible 10% gold allocation. Gold rises, they do nothing. Suddenly gold is 25% of their portfolio. This is portfolio drift, and it introduces concentration risk. Periodically rebalance to maintain your target allocation. This forces you to sell strength and buy weakness, which is the essence of disciplined investing. Gold rises 30%. You feel smart. You take profits. Gold then doubles. This happens because investors do not understand bull market structure. Major moves occur in stages. Early strength is often followed by consolidation, then further strength. Unless something fundamental has changed, real rates rising sharply, fiscal discipline emerging, de-dollarization reversing, hold your position through volatility. Gold attracts strong ideological opinions. Hard money advocates, doomsday preppers, inflation truthers. Some of their concerns may be valid, but ideology clouds judgment. It leads to overconcentration, confirmation bias, and missed risk signals. Approach gold as a rational allocation decision, not an ideological statement. Evaluate evidence objectively. Remain flexible as conditions change. Gold is one tool. It is not a complete portfolio. Some investors become so focused on gold that they neglect equity diversification, maintain excessive cash, or ignore income generation. Balance matters. Gold is insurance, but you still need growth assets, income assets, and liquidity. Gold will correct. It may fall 20% or more during this bull market. When it does, financial media will declare the bull market over. Analysts will proclaim gold's demise. If the structural forces remain intact, these corrections are opportunities, not exits. The investors who profit most from bull markets are those who add during corrections, not those who panic and sell. Prepare psychologically for volatility now, so you can act rationally when it occurs. Let's step back and consider gold in the broader context of the 21st century financial system. We are living through a unique period in monetary history. For the first time, every major currency is fiat, backed by nothing but government decree. There is no gold standard, no external constraint on money creation. This grants governments unprecedented flexibility. It also removes the ultimate accountability mechanism. Throughout history, when currencies were tied to gold, governments faced limits. They could not perpetually spend beyond their means. They could not inflate away debts without consequence. Today, those limits are gone. The constraints are political and psychological rather than mathematical. What happens when governments face a choice between default and inflation? They choose inflation every time. What happens when central banks face a choice between supporting asset prices and defending currency value? They support asset prices. These choices may be pragmatic in the short term, but they erode confidence over the long term, an experiment that has never succeeded over long time horizons. The dollar, the euro, the yen, all are young in historical terms. Gold, meanwhile, has served as money for thousands of years, across civilizations, across political systems, across technological revolutions. This is not nostalgia, this is pattern recognition. You're not holding gold because you expect a return to the gold standard. You're holding it because it is the ultimate monetary hedge in a world of competing fiat experiments. As long as central banks hold gold, as long as governments accumulate it, as long as it remains the neutral reserve asset, it retains relevance. The question is not whether gold is outdated. The question is whether the current monetary system is sustainable. If it is sustainable, gold may underperform, but it will retain value as insurance. If it is not sustainable, gold will prove essential during the transition to whatever comes next. This asymmetric payoff is why sophisticated investors maintain gold allocations despite its lack of yield. Cryptocurrencies have emerged as an alternative store of value. Some argue they will replace gold. Others argue they are complementary. The reality is nuanced. Digital assets offer portability, divisibility, and programmability that gold cannot match. But they lack gold's 5,000-year history, central bank acceptance, and physical tangibility. For now, both can coexist. Gold as the ancient, proven safe haven, digital assets as the emerging, speculative alternative. Over time, their roles may clarify, but in periods of uncertainty, proven assets tend to outperform experimental ones. Gold is the proven asset. We have covered substantial ground. Now, let's bring it together. The case for gold today is not based on a single factor. It is based on a convergence of structural forces that appear once in a generation. Central bank accumulation, unsustainable debt levels, geopolitical fragmentation, negative real rates, currency instability, any one of these factors would support a gold allocation. Together, they create a compelling risk-reward setup. But, and this is critical, gold is not a guaranteed winner. It is a probabilistic bet on systemic stress and monetary transition. If the system stabilizes, if central banks successfully navigate current challenges, if fiscal discipline emerges, gold may underperform. This is why position sizing matters. This is why diversification matters. This is why emotional discipline matters. They allocate to gold not because they are certain of crisis, but because they recognize crisis as a possibility worth insuring against. They hold equities not because they are certain of growth, but because they recognize growth as the historical norm worth participating in. They maintain liquidity not because they are timing crashes, but because they value optionality during uncertainty. This is the mindset that builds lasting wealth, not prediction, preparation. It will not make you rich quickly. It may frustrate you during periods of underperformance. It will test your conviction during corrections. But over time, across cycles, gold has served the disciplined investor well, not as a speculation, as insurance. If you own gold, review your allocation. Ensure it aligns with your risk tolerance and goals. Avoid overconcentration. Maintain discipline. If you don't own gold, consider whether portfolio insurance makes sense given your circumstances. If it does, establish a position systematically without emotion. If you are uncertain, start small. A 5% allocation is enough to provide benefits without introducing excessive risk. Complacency assumes the current system will continue indefinitely. It ignores warning signs. It leaves you unprepared for regime change. Panic assumes collapse is imminent. It leads to overconcentration, emotional trading, and portfolio destruction. The middle path is disciplined preparedness. Acknowledge risks, take rational precautions, but maintain balance and perspective. This is how you build wealth that lasts across cycles. This is how you navigate uncertainty with confidence. Gold is not magic. It is not a get-rich-quick scheme. It is not a solution to all portfolio problems. But in a world of unprecedented monetary experimentation, rising debt, and geopolitical uncertainty, gold offers something increasingly rare, tangible value independent of government promises. The signals we see today, central bank buying, negative real rates, currency instability, are not noise. They are structural, and they deserve attention. Whether gold reaches $15,000, $10,000, or $5,000 is less important than whether you have positioned your portfolio to weather the scenarios that gold protects against. The investors who will thrive in the coming years are not those who make the boldest predictions. They are those who maintain discipline, manage risk, and prepare for multiple outcomes. Gold is one tool in that preparation. Use it wisely, allocate rationally, hold patiently. And remember, the goal is not to beat the market. The goal is to build lasting wealth, preserve purchasing power, and sleep well at night knowing you are prepared. That is the path of the disciplined investor. That is the path we walk together. Thank you for your time and attention. If you found value in this analysis, please subscribe for more thoughtful financial insights. Until next time, stay disciplined, stay prepared, and stay rational. The market rewards patience, history rewards preparation, and wisdom rewards those who act before the crowd.